All right, so we're going to talk about chapter 13, which is kind of the basics of investing. Now, a lot of this information you've had in Finance 3000, and especially if you've had it in the Investings course, you've had some of this. So it's pretty light stuff. We don't go in real depth of doing calculations of stock valuation. We're just kind of talking about investments in general. There's your learning objectives. So why should you establish an investment program? Well, how do you do it? Well, if you remember, we talked about kind of SMART goals at the very beginning of the semester. So the more that you can be specific and measurable, you want a certain amount of money, X amount at this point in time because you want to pay for your kids' education, you want to buy a house, you want to retire, whatever it is, and then that will help shape what you should be investing in. So to develop valid goals, ask yourself, how much money do you need to satisfy your goals? How long will it take you to obtain that money? How much risk? So these are two. Big thing is risk. How much risk are you willing to assume? And keep in mind that typically the younger you are, meaning in your 20s, the more risk you should be willing to accept because you've got such a long period of time to go before you might need that money. Now, even though you're in your 20s and maybe you want to save for a down payment for a house, well, then that's a different situation. Then you're going to want to put it in a fairly safe investment for that period of time. And these are, of course, all on your handout sheet there. So, and these are questions that if you're going to be a financial planner, these are very similar to the types of things. Sorry, as I was saying, if you're going to be a financial planner, these are the types of questions you would be asking your clients. For those of you not going to be a planner, these are the questions you would be asking yourself. Okay? So here's an article I grabbed a couple years ago about people and retiring. And I put this up there because we've talked during the semester about the importance of planning for budgeting and so on. And this is saying that 48% of American households over the age of 55 have no retirement savings. Half of Americans over 55 have no retirement savings. So it's really a kind of a critical situation for our country. Now, that being said, a lot of people say, well, you know what? I'm just going to use Social Security. I'm going to just wait, because we all pay into Social Security if you have a job. And right now, the average Social Security benefit is about $1,500. Well, January. And can you live on $1,500 a month? Here's the poverty guidelines. So if you look at it, $1,500 per month, that's what, $18,000 per year, $18,000 a year, depending on how many people you have in your household. You're like right at poverty. If you're the only one in there, you are a little bit over it. But the point is, you guys don't want to be at or near the poverty line. So think about how you should be investing your money. Okay? So in terms of kind of performing a financial checkup, if you will, always make sure you're paying your bills on time. They put here ethical concerns because is really should be unethical if you're not paying your bills on time, really. Do you regularly spend more than you make? Like the number one thing in terms of being financially independent someday is simply spend less than you make. And about 20-some% of Americans don't do that. Manage your credit card debt, which basically means pay it off every month. Start an emergency fund. This is like the number one thing you do in your financial life. Build up an emergency fund. It gives you peace of mind if you want to leave your job and you're like, I don't have another job, but I hate my current job, but I have this fund that I've saved up and it'll at least help carry me over hopefully till I can get another job. You have COVID hits and you get laid off. So try to have like 3 to 6 months of living expenses in this emergency fund. And the emergency fund isn't going to be like in the stock market. It's going to be maybe in a savings account, which I know pays nothing right now, or maybe even a CD or something. Get you a little bit of interest. But the main thing is it's liquid. You're able to take it out. Okay. Also make sure you have access to other types of cash. Line of credit is not very typical, but credit cards are. So as long as you have a credit card and you got a credit limit of, a few $1,000s, whatever, you at least can use that if worse comes to worse. Okay. So it's great if you could always establish a larger than what you need emergency fund. Always make sure you know what you owe. A lot of people is like, I'm not sure how much debt I have. And therefore they just kind of keep building it up and it ends up, getting ahead of them. Reduce your spending as much as possible. This is just basic good financial information. Notify your credit card companies if you are unable to make the payments. So a lot of times your credit card companies will work with you if you're having issues. Maybe you temporarily got laid off and you're having a hard time making your payments, or you just got too ahead of yourself when it comes to debt. They will work with you because they don't want to, just you not pay anything. So they'll do whatever they can to try to maybe expand your payments, make them smaller, and so on. Okay? Always a good idea to monitor the value of your investments and your retirement accounts. And I wouldn't do this every day. Sometimes I get bad at that because it's just right there on my phone. I can just look at it, especially if the market's going crazy. It's really best to just invest it and forget about it. Put it on automatic pilot with your job. The money automatically comes out of your paycheck or out of your checking account, goes into the investment, and goes into like an index fund that invests in the stock market, and then you're done. Don't have to worry about it. Don't even look at it, because you're not going to need your money in most cases for many, many, many years. Okay, don't need to know. Okay, so getting the money needed to start an investment program. So how badly do you want to achieve your investment goals? If you need to have them done, then you are going to have to make maybe some cuts in your spending. You might have to get an extra job or whatever. Okay, are you willing to sacrifice some purchases? This is another big thing. So like number one is emergency fund. Number two is if your employer offers you a 401k, which is an employer sponsored retirement program, you got to take advantage of at least what they will match. So they will often match 50 to 100% of what you put in, up to a certain limit. Might be like $5,000. But if you put in $5,000, they put in $5,000, then you just made 100% on your $5,000 investment, risk-free. Got to take advantage of that. One of the best programs out there. Okay? Now, typically they're get capped at $5,000, but especially at your age, that's probably plenty. Participate in elective saving programs. So this could be like an IRA that you could put your money into. As I mentioned a minute ago, automatic. Try to do everything automatic. Your bills, have them paid automatically out of your checking account. Make sure your credit card has automatic at least minimum payment if for some reason you forget about it. Automatically have money come out of your payroll or your checking account to go into an investment program. Okay? They suggest, I haven't really done this myself, but make an extra effort. Take 1 or 2 months a year. You're like, okay, I'm not going to do anything crazy. I'm not going to travel. I'm not going to have any big entertainment expenses. I'm just going to really try my best to cut back on everything and put that money into savings. That would be great. Okay? A lot of times people say, well, you know what, I'm not even going to start an investment program because I have hardly any money. I started using Acorns about 3 years ago, and I think I have like $3,000 or $4,000 in there right now. And all Acorns does is round up on my credit card purchases. So it's just pennies like every purchase. And I don't really notice that it's taking money out of my account because it's over, it's a small amount over a long period of time, and that's added up. Okay. So we've talked about in Finance 3000 how just a little bit change in the interest rate can make a huge difference over time with future value. And this is just reiterating what I said about IRAs or 401ks, because these are investments that postpone taxes. So one thing I like about my retirement account is when I'm buying and selling stocks, I don't necessarily have to worry about, am I going to have to pay capital gains tax or dividends tax this year, because it's all going into one fund that I don't pay any taxes until I retire and I start taking it out. So I get that benefit of tax deferral for my life, and you do too, of course. So some things that are going to affect what type of investments you are is, how much safety, which goes hand in hand with risk. So risk is a measure of uncertainty, which you probably already know that. Speculative investments is a high risk investment. That's all it means. Okay. And I'm going to give you an article that talks about gambling versus investing, because a lot of people think that investing is gambling. And it's only like 1 or 2 pages, talks about kind of the difference between those. But a lot of these speculative investments can be on the verge of gambling. So to me, there's a difference between investing, putting your money in the stock market, looking for long-term growth, and gambling. To me, day trading is pretty much gambling. And I know some of you are already doing it. You've got your Robinhood app and you're doing it. Not the best way to go. We'll talk about day trading later. So I didn't include this on your handout, but you can pause me if you want. I don't necessarily agree with all of it. First of all, everything's kind of like average. And the problem is, like, let's take corporate bonds. It says safety and risk is average. Well, that really depends. You could invest in, say, like an Apple bond, and its safety and risk, safety is really high, risk is very low. You can invest in another type of corporate bond that maybe they're into biotech and they're trying to get a cure for corona, but who knows if they'll do it or not. That's a very risky bond. That company could easily go out of business. So corporate bonds, as the same with stock and preferred stock, these all could be all over the place. Okay? So I think they're just saying, on average, these types of investments are average, if you will. Okay. And if you could kind of look at a continuum, you could say, okay, if we look at risk, well, it's not the best chart here. I'm just trying to think here. And we can kind of look at return. This is kind of like expected return. Typically, it looks like this. You can, way out here at the end, this is the lottery. You have extreme risk, but you have potential to make huge return. And down here is your money underneath your bed, or you're in the bank or something like that. So stocks are typically up in here, and bonds are typically kind of here. Options, commodities, derivatives, they're all kind of way up in there, and so on. So that's what that chart is telling you about. So if you're a financial planner, you got to know this like the back of your hand. And if you're an individual investor, you're probably, all of you should be staying in kind of like these top 3 is where most of you, mutual funds would be the biggest thing that you'd be staying in. The other ones, as you get down here, your risk is getting a lot higher, and don't know if I would put my money in there. Okay? So once again, another chart here talking about kind of high risk versus low risk, and these are the various types of investments that would kind of go with the various types of risk. Okay. So this is an example of what you would go through if you're a financial planner with your client. And of course, if you're a client, what you need to be thinking about is, one is, what is your time horizon for your investments? And then how much risk are you willing to accept? So that's kind of what we've been, of course, talking about. So I forget where I got this. I think it might be a Charles Schwab tool, and it's really simple here. So it says, I plan to begin withdrawing my money in how many years? So your time horizon for, let's just say it's for you, it's going to be a long time in the future. And once I begin drawing my funds, I plan to spend them in, once again, if it's for retirement, it's going to take you a long time. So if you add those 2 numbers up, 18, and that's for your time horizon score. Your next one is about your risk. So your risk is, how much would you describe your knowledge of investments? And since you've taken some of these classes, you're somewhere in 3 or 7, let's just say 7. When I invest my money, I am equally concerned about losing or gaining value. Let's see, you're kind of right there. Investments that you currently own, I know most of you don't own anything, or I know some of you might, but let's just say you're kind of like most people, and you're kind of right there in stocks. And then it gives you some scenarios. Imagine in the last 3 months, stock market lost 25% of its value, and you also lost 25%, what would you do? Well, hopefully, at this stage in your life, you definitely shouldn't be selling your shares, and we'll talk about that in a few minutes. But if you have money, you might buy more shares, but most people probably just do nothing because they don't maybe have a lot of extra money. And then they give you a chart below. They say, okay, out of all these plans where you can see the interest or rate of return goes up, but also the worst case scenario gets really bad, where would you be? So let's just say you're kind of right there in the middle of the road. So if you added up all these points, 6, 5, that's 11, plus 10, 21, 28, so you'd be like a 28. And then we go to this chart over here, and you say, okay, time horizon, well, we're down here. So you're somewhere on this line, and you're like at a 28 or so, kind of right here, so you're like moderately aggressive. So it just really, so people your age are going to be somewhere typically right in here. And this will help you determine what types of investments you should put your money in. So here's an example of 5 different portfolios. We're going from very safe, fairly safe, to very risky. Okay? And based on what you just said in that last survey would kind of determine where you would be on this scale. So notice fixed income is basically the same as saying bonds. Okay? So bonds, so if you look at the yellow, really big over here, nothing over here. Okay? So as we move to the right, we get riskier and we typically have more stocks. So blue represents equities, so equities the same as stock. There's international equity, there's small company equities, so all these colors are stocks. And the yellow is bonds. So this is exactly the kind of stuff that you are going to be asked to determine if you get a job and you have to invest in a 401k, or even if you go on and open up an Acorns account, they're going to give you like 5 portfolios, and they're going to be very similar to this. And most financial planners would say someone your age, if you're looking to plan for retirement, should be probably one of these last 2 categories. So choosing higher risk investments, investors expect higher returns. So we've already kind of talked about that. How do we calculate the rate of return? You have an example right there on your sheet. So it's just really simple calculation. I'm not even going to go over it. You can do it there. Inflation risk, so other components of risk. As we've talked in Finance 3000, as inflation increases, you lose your purchasing power. Eats away at how much money you made. So for example, if inflation went up 3% and you made 3%, you really just, your purchasing power is not changing. You have interest rate risk, and we talked about this once again in 3000, that with fixed rate return decreases when the overall interest rates increase. So there's, once again, inverse relationship between bond prices and interest rates. Bond prices, interest rates, and we'll talk more about bonds later in the semester. But so you have a risk there when it comes to investments. Business failure risk, you invest in stock, company goes out of business, you lose money. Market risk means that, when we had the recession back in 2008, depression, and even when COVID hit, 90-some% of the companies probably dropped just because the whole market went down. So we have systematic risk and unsystematic risk. So this chart here is something that you might have seen in Finance 3000. I talk about it in my class. So here we have risk. So risk is higher if we go up, and then number of stocks in your portfolio. So if you have one stock in your portfolio, you're going to have very high risk. As you go to the right, your risk, of course, starts to go down, but then it eventually levels off. Why? Because you have what's called just general market risk. You can never diversify really everything, because if the stock market goes down, bomb goes off, a lot of people die or whatever, the whole market's going to crash, and even if you have a stock that has nothing related to it, it's still going to go down. But you can diversify against a lot of it, okay? And that's what we call unsystematic. So systematic is like the whole system. Doesn't matter, interest rates are going to impact almost the whole system, because businesses, when they borrow money, have to pay interest. So if interest rates go up, it's going to impact so many companies. There are a few exceptions, like banks can sometimes benefit from that. So anyway, this kind of point where it really starts to level off is typically like between 20 and 30 stocks in different industries. So once you've really hit that 20 number point where they're not all computer or high-tech stocks, but different companies, different industries, then you've really kind of eliminated a lot of your unsystematic risk. Okay? So there's just a real basic chart there of kind of the differences. Remember I talked about systematic risk, which could be like inflation or recession. Many companies are doing poorly. It's really hard to avoid that situation. Unsystematic simply means we can avoid it, and we can reduce that by diversification. Global investment risk simply means that part of your portfolio should probably be in some sort of international stocks. Okay? So this is kind of an interesting chart, just showing how since 1899, over 100 years ago, the size of stock markets, or world stock markets, have performed or have grown, I should say, since that time. So here's like 2020, and the blue, all this is the United States. Here's the blue over here, which represented, you probably can't see it, 15%, and now it's like 55%. So the United States economy, stock market, has just exploded over that time. The UK was 25%. The UK is now 5%. Japan, and you notice on the left here, we don't even see Japan, and it's 7, almost 8% here. So anyway, just kind of interesting. Try to get that a little bit bigger if you wanted to pause it and look at it. Another interesting chart I found were the annualized returns for global stocks for, once again, over 100 years. And you can see the United States has done very well. Australia's done a little bit better, supposedly. So United States at 9.4, Europe at 7.2, the entire world at about 8%. So that's a strong argument for investing in the United States stock markets, as opposed to just, hey, let's go find another market someplace else. And it's because we've done really well at innovating, and we have got a fairly decent business climate. So that's allowed our companies to perform better than a lot of other countries. Okay, investment income, meaning how can we receive money such as dividends or interest? Okay, so you all are familiar with putting your money in the bank. When you put your money in the bank, you have a savings account, or you can put in a certificate of deposit, or you can buy bonds. Bonds are ones that are going to be paying you interest. Preferred stocks tend to pay more dividends than common stocks. And of course, you can get mutual funds that have all of this stuff in it. And real estate, rental property, you collect rent. So that's the way we receive income. The way that we get growth, on the other hand, is typically it's going to be in common stock companies that pay little or no dividends. So if you're investing in, Facebook, Twitter, or something like that, Snapchat, most of those don't have any dividends. And the way you make money is by either receiving dividends or the price going up. So if your price is really going up, you don't care so much about the dividends. But if you're like a utility, like AEP, your stock's not moving a whole lot. You're not making that much more money each year. And all the money you are making, because you're not really growing, you're paying out in dividends. So you make your money through dividends. Okay? So liquidity, we've talked about this in Finance 3000, is the ability to sell an investment quickly without losing its value. So asset allocation refers to typically your money. How are you going to allocate your investment funds? So it's called asset allocation. Okay? Spread it over different types of assets, stocks, bonds, real estate, whatever. So the way that we kind of figure out where you should go is the time factor. Okay? Your age, A lot of times the type of investment should change with your age. So typically what we see happen is as you're younger, you're more into stocks, equities. As you're older, you get into more fixed income or bonds because they're more conservative. So that's kind of what typically happens. So here's a chart kind of showing you what I just said. So there's your mid-20s, mostly stocks. 30s, look at the blue and the red. So the red's kind of increasing. Okay? And so you remember this is real similar to what happens with conservative versus aggressive. So we start off aggressive, we get more conservative as we get older. So stock is the same as equity. So we have equity capital is money that a business obtains from its shareholders. So when you buy a share of stock, you're becoming part owner of that company, and that's what we call equity investing. There's two types of stocks you can buy, common and preferred. And our next chapter is all on stocks, so we'll get more into those later, so I'm not going to say anything about them now. Bonds, and we'll have another chapter on bonds, so I'm not going to get much into it. Bond is basically a loan to a corporation, so I can give money to a corporation, to a government, and that's, instead of calling it a loan, we're just going to call it a bond. Okay? They're going to pay me interest, and then they're going to give me my money back at the end. And that's how you primarily make money with bonds. So mutual funds, they pull, let's say I wanted to start a mutual fund. I could say, and I ask all of the students in this class, 4100 class, we're going to start a 4100 mutual fund, and I'm the mutual fund manager. Say, okay, everybody give me how much money you want to invest. Some of you give me 20, some of you give me 100, whatever. And I pull all of this money, and then I decide which investments to buy. Now, I need to tell you up front, am I going to be buying stocks? Am I going to be buying bonds? Am I going to be buying a mixture? Am I going to be buying hospital stocks? Am I going to be buying all stocks? Whatever. Once I determine that and I tell you, then you say, hey, that's my professor, so I'm going to have trust in him because he probably knows more than I do. So I'll give my money to that mutual fund. Mutual, we're all in this together. You buy shares in the fund. If you bought $20 worth and I collected $20,000 from all of you, your $20 is going to be spread out amongst all of those different investments. So it's a great way to get diversification. Okay. Real estate as another asset that you can be investing in. It's okay. Definitely a lot of pros and cons with that. And nationally, real estate has increased 3 to 5% annually. You know, it can go down, of course, sometimes. It's more of a long-term investment, not really get rich quick unless you're trying to like flip houses, and that's possible. Big factor is location. Okay, here's the median home price from 1951 to 2020, so last 70 years. So the orange represents inflation adjusted, the blue represents the actual price. So we're down here of like $20,000 in 1953. And about a year ago, it was around 280,000 right there. So if you look though, for adjusting for inflation, look at these years. This is 1950 to 2000, and it really did not change that much. But you bought right here, you did really well if you sold right there. But then we had the big recession, things fell, and now it's back up again. Still, if you look at how it has changed over a long period of time, it hasn't been the best investment. Yes, it's gone up for price, but inflation, when you factor in inflation, it's pretty flat. So you got to be careful about real estate. So these are just some questions. I'm not going to read these. These are questions for you if any of you are thinking about being a landlord or getting into real estate as an investment. Kind of the last category are speculative investing, which I would advise against. You know, speculative investing is really close to gambling. I mentioned this earlier, and we're going to talk about day trading when we get to stocks, which is next chapter. But anyway, all of these are forms of speculative investments. Some of you may have already done options. I doubt most of you really done anything else. I'm not sure where like Bitcoin would fall in this, but you know, Bitcoin would be another one. It's not this kind of coin, but Bitcoin is very, very, very speculative, and other cryptocurrency. But anyway, it's really close to gambling, and you can get even the stocks. That's, you know, day trading, just buying and selling every few minutes or something. That's to me borderline gambling. Um, so just practical advice right there. Um, One thing you do need to consider are the tax consequences of selling. That remember that when you sell something for that you've held for less than 1 year, you're going to have short-term gains, capital gains, if you made money, and you're going to be taxed at a different tax rate. It's kind of like your ordinary tax rate than if you held it for greater than a year, and you can be taxed at long-term tax rates. So there's a certain percentage, I forget off the top of my head, maybe $40,000 that you can make, and you're not even taxed on it. So that's really important when you're thinking about, should I sell this investment now, because the taxes on there should potentially, or could potentially impact how much money you make or lose. Okay, so it depends on how much you make, and 1 year is the critical time period. So that's very important to remember, especially, well, even if you're going to be a financial planner or not. That's just a good thing to know. Okay, that's it for kind of the basic investment chapter. The next chapter will be on stocks.